Portfolio Analyzer can actually help you in three fundamental tasks: prospecting and getting new clients, maintaining your customers' portfolios, and retaining your customers. When you meet a new potential client, one of the best things you can do is talking about his current portfolio and perform a complete risk and return assessment. Then you can show his current portfolio against an efficient frontier plotted with assets he already holds. Then you can go one step forward and suggest other assets that he doesn't hold but that could improve portfolio's risk-return ratio. As a financial advisor, you should periodically review your customer portfolios. Are they still efficient? Does current asset allocation need to be changed? Is it necessary to rebalance portfolio weights? Portfolio Analyzer lets you answer all these questions, and most of all, it tells you what to buy and what to sell depending on your client's goal. This is the Portfolio Analyzer. It looks pretty complex, but we will see everything step by step in this lesson and others. A complete analysis involves 4 different steps. Step 1. Enter or load all portfolio holdings. They can be stocks, bonds, ETF, ETP or investment funds. Step 2. Analyze loaded portfolio, expected return, volatility, composition, etc. Step 3. Optimization and efficient frontier analysis. Step 4. Backtesting and Monte Carlo simulation. We will go through these 4 steps in dedicated video guides. But before that, we will provide a general overview of the full process. Step 1. Enter or load portfolio holdings. Portfolio Analyzer handles several financial instruments. Single stocks. You can enter any stocks worldwide listed through its Yahoo symbol. For any given stock, Portfolio Analyzer helps you in the following: finding the most correlated market, computing relevant beta and adjusting exposure by beta and currency. We will go in deeper detail on how stock holdings are managed in another lesson. Single bonds. Portfolio Analyzer can handle all bonds listed on the following markets: Berlin Stock Exchange, MOT plus EuroMOT and EuroLX. Portfolio Analyzer can automatically handle more than 6,000 exchange-traded products from several exchanges. Investment funds. Portfolio Analyzer handles more than 9,000 investment funds. Plus, you can ask to include missing investment funds. Last but not least, you can enter any custom security beyond Portfolio Analyzer covered universe. Step 2. Portfolio Analysis. Once all holdings have been entered, Portfolio Analyzer converts all of them in terms of exposure to appropriate financial markets. Let's suppose we have entered the following portfolio holdings: 100 shares of the Elixir Eurostoxx 50 ETF. Portfolio Analyzer will tell us all the following: which market is mostly correlated to that instrument, which is the last available price for that instrument, both in original currency and in portfolio reference currency, which is the beta of that instrument against the given correlated market. In our example, we could have portfolio currency is euro. Mostly correlated market is equity euro large cap. Last price is 31.04 euros. Beta is 1.0824. Our holding is 100 shares. It means that 100 shares of this ETF are valued almost 3,104 euros. And it also means that same position corresponds to a beta-adjusted position on the market equity euro large cap worth the following: 3,104 euros, that is the current market value of our actual holding, multiplied by beta, that is 1.0824. So our actual holding gives us an exposure to the equity euro large cap market of 3,359 euros. Every single portfolio holding will be converted into a corresponding beta-adjusted exposure to relevant benchmark index. This is a typical example of portfolio grouped under market indices. Here, a single bond together with an investment fund have been grouped under the common index Bond Euro High Yield Index. All positions will be aggregated and you will be given the following result. Portfolio's expected return, portfolio's expected volatility, current portfolio value converted into portfolio reference currency, actual beta-adjusted portfolio exposure. This number takes into account the betas of each holding against its corresponding index. And this is the base for return and risk calculation. An expected return of 1.04% means an expected income of beta-adjusted portfolio value times expected return. That is to say, 700,195 euros times 1.04%. It means that you expect an income of almost 7,282 euros. You will also be given the following charts. Portfolio composition split into following asset classes: equity, fixed income, commodities, real estate and private equity. Portfolio exposure by geographical areas. Portfolio currency exposure. Expected portfolio VaR with a confidence of 95% over several time horizons from 1 week to 1 year. Step 3. Optimization. The third step is a double automatic optimization. Why do we say double? The first optimization is performed with the same assets currently held. It is aimed to see if current allocation is efficient or if it can be enhanced simply changing the weights of currently held markets. A second optimization is automatically performed by the system seeking additional markets, not currently held, capable to improve global portfolio diversification. Here's an example of double optimization. This is our current portfolio. Blue points are the first efficient frontier. Red points are the second enhanced efficient frontier. These asset allocations offer similar return with low risk. These asset allocations offer higher returns with the same risk. Red points belong to the enhanced efficient frontier, and most of the times offer a better risk-to-return profile. This is due to our proprietary algorithm that selects additional markets to include into the optimization process. You can click any point in the chart to see asset allocation details. This is the analyzed portfolio. And this is its composition. Here are expected return and expected volatility. This portfolio has a higher return with a lower volatility. This is the full list of all other portfolios in the chart. And this is the list of transactions to perform to change old asset allocation into the new one selected from the chart. Step 4. Backtest and Monte Carlo simulation. As a cherry on the cake, we can go ahead in the process and compare how both portfolios behaved in the past. And, above all, how they are expected to behave in the future. We can go back up to 10 years in the past. We can even define a rebalancing frequency. The system will automatically download historical weekly prices for relevant markets and currencies. This is the past. And this is the future. The blue line is our currently analyzed portfolio. The green line is the new portfolio. As we can see, in the past our old portfolio behaved better than the new one. That's fine, it means that we did a good job. But what about the future? A Monte Carlo simulation can help us assessing future portfolio evolution. Starting from expected return and volatility, the software simulates hundreds of future paths for both portfolios. It then plots all of them together with their average, bold yellow and orange lines. We expect on average a negative return from old portfolio, yellow line trends downside, while we are more positive for the new portfolio. Also, differences in volatility are easy to see from the chart. The wider the area where simulation spread, the higher the volatility. Actual performance could be extremely worse than what's expected on average. But it could also be much better. Smaller area means lower volatility, and therefore less uncertainty. Finally, you can print or save a full report for your client.